Good morning, and we want to welcome you to our call today with Ed Newton CPA, CFP, and President of Newton Financial Network. The title of our call today is Tax Update for 2014, or Your Taxes Are Going Up. If you're listening on the phone, if we have time at the end of the call, we'll open up the phone line so Ed can answer any questions that you have. Or if you're listening via the webcast on the Internet, there is a box towards the bottom of the page titled Submit Your Question for the event here. If you want, just type in your question, click on the Submit button, and again, we'll check those messages at the end of the call and try to answer those too. If you are not already a client of Ed's, he's originally from Huntington, West Virginia, has a degree in accounting from Virginia Tech, and a master's degree from Liberty University. Ed landed at Arthur Anderson & Company in their tax department and then began his CPA firm in 1977. He is a CPA and a certified financial planner and is uniquely positioned to help his clients achieve and sustain a worry-free retirement. And if you do know him, you know Ed has also been a commercial pilot and is now a captain for a major airline since 1982, and his current weekend routes are to London, England, and Frankfurt, Germany. Ed, good morning and welcome to the call.
Good morning, Jeff. Thank you very much for that introduction, and hello to everyone. Appreciate you being on the call today. This is the last call of the year 2014, and looking forward to a bright future in 2015 as well. We've done some work in the last three weeks internally, and I just want to let you know that we are going to be doing these calls more frequently. Next year, we already have them planned out for the entire year, so hopefully you'll be able to join us on some of those, and that we'll be able to impart some good information to you. As Jeff said, the title of this one, the tax update for 2014, and the real answer is, or the real topic is, your taxes are going up. Unfortunately, that's the case for this year. Almost assuredly, everyone will pay more taxes. Normally I have all my notes and everything scattered about the desk and ready for you. I still have them ready, but the point being, today I actually had to work on them almost up until the moment we got on the call. Due to the fact that I'm sure many of you have heard, the House has passed what they call the 2014 Extender Act, and I still want to go over items that I was going to, because only the House has passed it, the Senate has not, and of course the President has not signed it into law, so it's not law at this time. Also, I do want to say at the beginning, and I'll probably say it a little bit later when we do talk about the Affordable Care Act, nothing that I say on here, I promise you, is of a political nature. It is just the straight facts as it is, and that is, it affects people's income tax returns. So if I happen to make some reference to, and I probably will call it Obamacare, because that seems to be a tag that has attached itself to the Affordable Care Act, but I do not mean it in any political way at all. So that's my disclaimer. That's the biggest disclaimer I have. So let's talk about it a little bit. 2014, what's going to happen to your tax return this year? Well, one of the first things that we're going to find is that a lot of the deductions that many people take on their tax returns have disappeared or are going to be severely limited. Some of these crept there into the 2013 as well. We did discuss with a lot of clients when we were preparing their returns for 2013, when we did them in 2014, that we discussed a couple of things that had changed and caused their taxes to go up, as we always do with clients, show a comparison between the last year or two so that you can have an idea of how your taxes are trending. So that's also this year in 2014 as well. One of the biggest things, and we will spend some time on it today, and I know, again, we talk about 2014 taxes. I mean, we're talking about your tax return, but trust me, the Affordable Care Act, excuse me, is a major part of the changes of the 2014 tax law. The Internal Revenue Service has been given the task of implementing all of the provisions of the Affordable Care Act as it pertains to the exchanges, the credits that are available to some taxpayers, the taxes that will be charged on other taxpayers, etc. And so I can tell you that without question, no matter what your circumstances are, the Affordable Care Act is going to affect your tax return this year. That is a 100% given. I'm going to move that towards the end because that is a little more detailed. I'm going to try not to get into too much detail, but just to let you know some of the things that are happening. So the first thing I'd like to do is to talk about the 2015 pension plan limitations, which are a positive, and so let's try to start out on a positive note. For those of you that have 401ks or government-sponsored plans, the amount that you can put into your 401k increased slightly for the year 2015. In 2014, it was $17,500, and in 2015, it goes up to $18,000. Those of you that are over 50 are probably familiar with the term catch-up contribution, and for 2014, that number was $5,500, and for 2015, it's $6,000. So those of you that are under 50, you will have, again, $17,500 to $18,000. Those of you that are over 50, for year 2014, you could put $23,000 in. For 2015, rather, you'll be able to put $24,000 in. So that certainly is a little bit of a help, not a great deal, but it is a benefit there. The individual retirement account, the IRA, remained unchanged. They didn't change that this year, so it's still $5,500 for the regular, and excuse me, an additional $1,000 for those that are over 50, so $6,500. Some folks have talked to me about, and we've talked to a lot of clients about the Roth IRA. A lot of our clients are not able to do a Roth because of the income limitations. For the year 2015, that limitation has been raised a little bit, not significantly. And so there's not much change in that, although I do want to briefly touch on what some people may have heard, and we've talked to some clients about it, and that is converting your IRA to a Roth IRA. That can be done. There are some pitfalls, but even if you make over the limits of $193,000 for the year 2015, you can still make a Roth contribution. As silly as it sounds, this is the way that the law works. In order to do that, what you would do is make your contribution to a traditional IRA. So let's just say you take $5,500 and put it into a traditional IRA, and literally the next day, we usually wait a month or so, but literally the next day you could convert that to a Roth IRA and put that $5,500 into the Roth. And that would be perfectly permissible under the law, although if you had just made the contribution directly to the Roth IRA, that would not be permissible under the law. So, again, I'm not going to call it a loophole, but it's one of those inconsistencies in the tax law. So that pretty much covers the 2015 pension limitations. For those of you that may be involved in a company pension plan where they also contribute for you, the maximum for 2014 was $52,000. That's gone up to $53,000 in 2015. But that also has to be coordinated with your contributions to the 401k. So I think the easiest way to sum that up is to say that if you are in that situation where your company is contributing to a retirement plan for you and you are also contributing to your 401k, I would suggest that we have a brief discussion. Many people think that, well, I should not make my 401k if the company's going to make it because I don't want to hit the max, etc. But there's some other things there that I think would be beneficial to chat about. So if you're in that situation, excuse me again, I would suggest that we just have a brief conversation about that. Now, for the taxes themselves, we'll look at some things that have happened and the way the tax law is now, and then I want to discuss with you what Congress is proposing. Many deductions ended in 2013 for individuals. And among those, some of these are very minor, others are much more substantial, but I just want to run down those, and then we'll talk about the Congress's provisions. Up until the end of 2013, school teachers and other educators, elementary and secondary school teachers, were able to take what we call an above-the-line deduction for amounts that they spend for the classroom of $250. Again, I realize that's a very small amount. I have no idea why they make it so small. Certainly for our teachers, they should be able to write off substantially more than that. But at any rate, that deduction for the school teachers went away at the end of 2013. Another one that I'm thankful to say has not affected many of our clients, but it has affected some, and if it affects you, certainly this is a quote-unquote a big deal. If you have had a mortgage or any discharge of mortgage debt, to use the vernacular, if you were underwater in your house, you did a short sale, you modified the loan with the mortgage company or anything like that, whatever the mortgage company forgave of indebtedness turns out to be income for you. A lot of people didn't know that from the beginning. More and more are finding out about that. But if, in fact, the mortgage company did discharge any of your indebtedness on your principal residence, there was a provision that allowed you to exclude that from gross income. So if you had a house that had a $300,000 mortgage, the house had dropped in value to only $200,000, you negotiated a settlement with the mortgage company and they forgave the other $100,000. If that was your principal residence, you would not have to report that as income. That ended at the end of 2013. So if this happened to you in 2014, that $100,000 would be additional income that you would have to pay taxes on. Mortgage insurance premiums. Again, those folks that get mortgages with less than an 80%, 20% ratio, if you put down less than 20%, you were required to have mortgage insurance. that mortgage insurance has been able to be deducted on your return in certain cases depending upon your gross income, and that ended in 2013 as well. For our friends on the call that are from Texas, Florida, and a couple of other states, as you know, you have no state income tax, and several years ago the Congress enacted a provision which said, okay, you can deduct either the state income taxes that you paid or the general sales tax in your state. And the general sales tax was always done by computation. There was no records that you had to keep, it just based on your income. And then we would go to the tables and look at that and find out what that sales tax number would be. Well, unfortunately, that ended in 2013 as well. One of the bigger ones that ended in 2013 that will affect many clients this year, 2014, is the deduction of tuition and related expenses. Again, that used to be an above the line. It went on the first page of the tax return as a deduction, which is always good, versus being on Schedule A itemized deductions. That also expired in 2013. And then finally, for individuals, the extension of the tax-free distributions from individual retirement plans for charitable purposes. We didn't see many people do this, and there's not a huge benefit there, but if you were using your IRA to make contributions directly to a charity, that ability ended in 2013 as well. Now, many of you on the call do have businesses, and we've talked with you about this, that it expired at the end of 13, but I just want to reiterate it, and that is what people call the Section 179 expensing for assets. Typically, if you buy an asset, a piece of equipment for your business, let's say a $50,000 piece of equipment for your business, then you were able to actually write that off in 1 year instead of depreciating it over numerous years. That ended, at least the large caps, in prior years from up until the end of 13, you could actually do $500,000 could be written off in 1 year of new equipment. In 2014, it went back to the quote-unquote old law, which is only $25,000. That's exactly right. It went from $500,000 ability to write off in 1 year to $25,000. So that is a huge, huge tax increase for the government and a real detriment for the individual or the business at any rate. So that being the bad news, let's talk a little bit about what is hopefully good news. And I say hopefully because at this point it has only passed the House. The Senate is to take it up, I think, day after tomorrow, or it may even be tomorrow. And we're hopeful that it will get through the Senate unscathed without any changes, so that it can go direct to President Obama's desk instead of having to go back to the House and work it out in conference, any changes. Most of those items that I talked about just in the last few minutes will be extended, and that's the reason I wanted to bring those up. I wanted to give you the bad news first, but then give you what I hope will be good news going forward. So just to hit those briefly, since I did discuss them a little bit in depth as I just talked about them. The House bill, which is H.R. 5771, and it's, again, the way they name these bills, the Tax Increase Prevention Act of 2014. It does restore the elementary and secondary teachers' ability to deduct the $250 above the line for eligible expenses. It was certainly hoped that that would be raised to something more reasonable, but that's not what the law has or what this bill has. Also, the gross income, the income from the discharge of indebtedness on your principal residence, that's also been reinstated for the year 2014. And that's, again, is just 1 year. So a lot of these extenders are just doing it through 2014. And we may have to fight this again. One very small one, but it does affect some folks. If the company, if your employer pays for your mass transit or parking benefits, then that is non-deductible again for 14. That had been expired in 13, but now will carry through to 14. Same thing with the mortgage insurance premiums. You'll be able to deduct those in 2014. The state and local general sales tax, so our friends in Florida and Texas and those other states will be able to deduct the general sales tax as well. The tuition has been reinstated for the year 2014, the deduction for that, as well as the tax-free distributions for the individual retirement accounts. For our business clients, the really good news is that they did extend through 2014 the Section 179 increased expensing limitations back up to the $500,000. So that was one that certainly would have caused a lot of problems for our clients, and that did get extended as well. And then that pretty much covers the changes in the taxes for the year 2014. Now let's get in and talk briefly about the Affordable Care Act. And just to give you an idea, Jeff has put up on the screen now a slide that shows some of our health care coverage under the ACA, what needs to be done. I promise you I will not walk you through this flow chart. The only reason I put it up and had Jeff put it up is because I wanted you to see from a flow chart standpoint just how convoluted this is. And I just spent, in the last 2 months, I've spent probably 3 days talking about the Affordable Care Act in conferences, and a conference that I go to that's 2 days long on tax updates. We spent well over 1 full day just talking about this. Now, as I said at the top, the Affordable Care Act is going to affect every single tax return for this year, and I will discuss that in just a second. It also means that we are having to take extra steps in making sure that you are complying with the Affordable Care Act. Again, since I mentioned earlier, the IRS has been given the oversight for that. They have pushed it down to the CPAs and other tax preparers, and we are having to invade your privacy in some respects, I guess is the way to say it, concerning your health care coverage. So, again, for every single tax return, we have to put on the tax return whether you and every member of your household that you are claiming as a dependent had health care coverage for the entire year. So you can just anticipate that when we get together, we're going to ask you that question. Did you have health care that met the standards of the Affordable Care Act for the year 2014? Now, many people think that if you work for a large employer, and since I do fly for the major airline, as Jeff says, which is U.S. Airways, and I think most of you know that. The New American. A lot of people say, well, Ed, you know, U.S. Airways provides our medical insurance, so I don't have to worry about the ACA. Well, that's true and not true. The employer mandate does not take effect till 2015, but for 2014, we still have to ask the question as to whether you were covered by a plan for 2014, and we have to ask if every member of your house was also covered. So, for example, it's quite possible that, let's just say, one of the husband or wife is a pilot at U.S. Airways and covered, and maybe the spouse works another job and they've been using the health care under that other employer. Well, we'll have to inquire as to whether that spouse's health care insurance qualified under the ACA or Obamacare. I think I've held off using Obamacare until just now, so anyway. So that's going to be something that is going to, like I said, affect everyone. Now, if you do not have a employer-sponsored health care plan, we really have to, the only way I know how to say it is get into the weeds with your health care. We're going to have to discuss whether you bought the plan through a broker or whether you went through they're now calling it the marketplace. They were calling it early on, they called it the exchange, but now they're calling it the marketplace. I guess it had a little better commercial value, if you will, to call it the marketplace. So we will have to determine whether you got it through the marketplace or through an insurance broker. We're going to have to determine whether that policy meets the standards of the ACA, and then there are various new forms that we're going to have to complete, including the 8965 and an 8966, which have to do with affordability. It's possible that some of our clients receive the subsidies, and some of you that are listening on here may have received a subsidy from the government. They may have indicated to you that that was a discount due to your income levels, but it actually is legally a subsidy, and we'll have to get into that discussion as well. The penalties for an individual not having adequate, according to the government, adequate health insurance for the year 2014 is not as onerous as it will be for 2015. So if, in fact, you come under this for 2014 and do have to pay any of this penalty, the most that you would have to pay for this year is $95 per adult, and that's limited to $285. For 2015, it goes up significantly, and so then we'll need to look at that for next year. It actually goes up for 2015 from the $95, it goes up to $325 per individual that does not have the appropriate insurance according to the ACA. I really think if I get too much more into that, it's going to really get us into the weeds and will be quite difficult to try to discuss. But just, again, be aware that the ACA for this year will affect your tax return. If we prepare your tax returns, then I would say, well, I shouldn't say I would say, we will be discussing that with you. If you don't use us to prepare your tax returns, please make sure that you have that discussion with your tax preparer. And if your tax preparer is not aware that this discussion needs to take place, the only thing I can say is I would find a different tax preparer, because this is something that is affecting, again, everyone this year. With that said, my voice is getting a little dry, and I think I've pretty much covered everything that I want to hit there. So I'll ask Jeff to just throw up our next slide there, which just to let you know, to get started with your 2014 preparation, the earlier we get started, the better that it will be for all of us. The government has not come up yet with the initial date that they will start accepting 2014 tax returns. You may recall last year that they pushed that off until just almost February 1st. It appears that it will probably be that late again this year, due to the fact that Congress has waited so late in the year to do these extenders. So when you have your items ready, we will, and one other thing I should say before that, one of the things that we're required, we've been working on every year, but this year it's come down a little harder on us regulatorily wise, and that is an engagement letter. So expect the first week of January to get an envelope from us that has an engagement letter in it, that we will ask you to sign that and return it to us. And we are going to include a self-addressed stamped envelope in there as well. So we'd ask that you just go ahead and sign it when you get it, put it back in the mail to us so we can put it in our files. And then when you are ready to sit down with your tax information and get that to us, whether we do it individually in a meeting or whether you send it to us electronically or by paper, then we'll have all that in hand. So call Sarah Beth, 704-552-8689, and then, or you can send an email to Ed Newton at ednewtoncpa.com. I think that should do it for now, Jeff. If you want to open it up to see if anybody has any questions, that's fine. Otherwise, I'll just let you close it out.
Sure, Ed. The phone lines are open, so if you're listening on the phone, you can go ahead and just ask your question. No need to press a button. Let me check on the internet side. Somebody mentioned they'd like to earn CPE credit for these webinars.
Yeah, I'm not sure what type of CPE they would be looking for. We haven't registered any, I will say that. However, if it's something that you want to get in touch with us about, we can certainly see if we can do something for you.
And then Bill from Monroe asked, are there slides for the webcast? Bill, the short answer is yes. We just had the one really informational slide on the ACA or Obamacare. But I think on the other information, Ed, as you just kind of walked to it, we don't have any slides for that, but you can listen to it again on the replay.
Right, and that would be, I'd say, Jeff, just even though I know you'll do it at the end, but you may just tell people about the replay right now.
Sure. We'll turn this audio into a video, post it on YouTube, and give you a link for that, plus post it on Ed's site at ednewtoncpa.com, and we'll have a page there so that you can listen to it again. And since it's in a YouTube video format, you can step through it, go forward and backward, and skip over any part that you want to find, the area that you have of interest. So that'll be up there, and we'll probably post that, if not later today, first thing tomorrow.
Okay. So anyone have any questions? I guess I've answered them all, Jeff, sounds like.
Okay, well, great. Well, we want to thank... What's that, Ed?
I just laughed.
Super. We just want to thank everybody again then for being on the call. Like I said,
can you hear me?
Sure. Aaron, go ahead.
Oh, hey. Ed, I do have a question. One of the notes that I made, thank you so much for doing this, by the way, just for us and, like I say, my little brother who's self-employed. I actually converted my IRA over to a Roth back in the 90s, the first time, when at first they said you could do it and pay it over 4 years.
Over 2 years, right. Yes, Aaron.
Or 2 years or however it was. So because I didn't have very much in it back then, I already paid the Roth. So I guess my question is, it's growing tax-free, I presume, and if maybe that's where I should be contributing more than the 401k, I'm not really sure. I mean, that's certainly a question for when I meet with you, but I did want to ask if you already had a Roth.
Yeah, in a general way, let me say this. First, I'm glad you did it back in 2010 where you were able to put the amount over, and pay the tax over 2 years. As far as going forward, whether it's a 401k or a Roth IRA, that's something that definitely I'll make a note, Aaron, and we'll talk about when we get together. That is pretty much individual circumstances. A lot of it has to do with age and how much you do have to set aside and that sort of thing.
Right. But, I came to you because I was, thought that my taxes had been done wrong, and they had been done wrong. But I actually rolled that over, made a Roth IRA back in the 90s when you first could do it. So why that worksheet is there, because I think you just said it seems like I did it in 2010, but I actually did it probably like 96, 97, whenever the Roth, you could first convert to a Roth when the law changed. And I thought I took like 4 years. I only had, I think, $10,000 in there at the time, and then let me pay the taxes on that amount over 4 years, and then supposedly after that.
Okay, Aaron, as you indicated, we just started doing your return last year. Right. Let's definitely visit that in detail when we do this year's tax return.
That sounds great. I didn't mean to take up. I just was curious about, if you already had the Roth IRA for anyone who was listening, if you already had it, because you were talking about, making the contribution. So obviously, as you and I both know, that's a question. And with my age now, doing that. So I appreciate you letting me ask the question.
Absolutely. And like I said, that's something we'll definitely talk about this year.
Okay.
And review what happened, in the past before we started working with you.
Exactly. And I've got everything for 10 years, so I'll just make notes from today and things that for that, so I won't take up any more of your time in case someone else would like to ask a question.
Okay. Thanks, Aaron.
Okay, thanks.
And again, the lines are open, so if you do have a question, just go ahead and speak up. We've got a lot of people.
Ed, hi. This is Bill. Can you hear me?
Yes, Bill.
How are you, sir? Thanks
Good.
for having this webinar. I'm doing great.
You.
Thanks for having this.
Glad to do
Thanks for having this webinar here. I had a question for you. I'll be participating in a 401k beginning next year. I know that right now mentioning the IRAs. I mean, you and Sarah Beth have been really taking care of me well on that. But I just had a question. Do you have any kind of modeling or whatever that makes sense for example, with my age, and I know that the 401ks have a catch-up provision after you reach a certain age.
Correct.
Do you have models in that would help us, maximize our tax benefit while allowing the catch-up rules to apply?
Absolutely.
I mean, is there some kind of, based on the income, and the age, what's the critical mass that, saves me the most amount of money while saving me the most amount of taxes at the same time?
Absolutely, and that's something we do, Bill, certainly with clients, is to look at what they have at their employer, and I will say that's something that I think that differentiates us from some other advisors, and that is that we do want to work very closely with the client on their employer-sponsored plans as well, because if you've got your employer-sponsored plan going in one direction and your IRA that's managed, by someone going in a different direction, they could be going in opposite directions and you're not getting the benefits. So we would welcome the opportunity to, work with you on that, to get the choices that you have for the 401k, as well as talk about maximizing the deduction, including the catch-up. So that's definitely something that we'd like to do. And what I would suggest, Bill, is even before it's time to do your tax return, just give Sarah Beth a call and let's talk about that for you specifically, but it's definitely available for anyone that would be interested in us working with them on that.
Okay, awesome. That's great. Thanks. I will do that.
Okay, thanks, Bill. I do want to thank everyone for being on the call today. I appreciate the participation. And again, if you've got any questions at all, feel free to give me or Sarah Beth a call, 704-552-8689, or send an email to ednewton@ednewtoncpa.com. And one other thing I've just got to throw out that I'm kind of excited about, the last week of February and the first week of March, listen to WBT Radio. We're going to have a few spots on there, so I'm excited about being on the radio, if you will. Okay, Jeff, take it away.
Great, Ed. Thanks again, and we want to thank everybody for being on the call. Again, if you have a question, if you're listening to this on the replay, give Ed a call at 704-552-8689 or Sarah Beth there in the office. And again, this has been Ed Newton, CPA, CFP, and President of Newton Financial Network, and today's call was Tax Update for 2014, or your taxes are going up. Thanks again, everybody. We appreciate it. We'll talk to you soon. Bye-bye.
Bye.